Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in live from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's hot sheet, I will discuss the U.S. Treasury Yields, mortgage applications, debt payments, and T360's real estate rankings just released. Today is Wednesday, March 15th, 2023. I am Byron Lazine, and the hot sheet starts now. I think we left yesterday, certainly came into yesterday, feeling really good about what took place on Monday. Monday regional stocks, for regional bank stocks rather, were down significantly, but then the fear and the potential contagion started to subside. Tuesday morning, we came in yesterday, and we saw that all of those regional stocks were back up. Somebody tweeted me in the discussion saying, "Hey, Monday was just a buying opportunity. It's all past. It's all over now." The big gov came in and saved the day Sunday night when they guaranteed depositors that they would be fully insured on their deposits for SVB and Signature banks, which they did Sunday night. Well, now it's Wednesday morning, and what we see is that U.S. stocks are sliding. Market just opened a minute ago. Let's see what the market is at. It's down 600 points on the Dow. It's a full 2% almost. S&P's down 73 points. NASDAQ is down 160 points. Okay, so the Dow is down almost 600 points as Credit Suisse adds pressure to an already troubled banking sector. Okay, so Credit Suisse shares tanked 30% after a Saudi backer rules out further assistance. So they're another bank in need of assistance. They actually are one of those banks that will also lend to some of these VCs, like we saw the regional bank in Silicon Valley doing. Okay, Credit Suisse is one of those banks that will make big investments into companies or VC funds. Okay. Now you're seeing all of the regional bank stocks. A rebound in regional bank stocks has lost steam, according to Wall Street Journal, and investors resumed their flight to government bonds, which is creating a sharp decline in yields falling across the board. The little silver lining here, hit the thumbs up if you're in real estate. We're not rooting on any bank collapses, that's for sure. That would ruin any type of housing market. So we don't want to see that. Let's be clear. But a little bit of a silver lining is that 10-year has dropped significantly. We're back under 3.5 today, which gives the potential here for us to drop under 6.5 on the 30-year fixed. Right now, we keep operating with that 3% spread from the 10-year to the 30-year. Historically, it's closer to a 2%. But since the raise of rates, we've seen this 3% spread. And I'm going to go, I know we usually go 10-year at the end of the show. I'm going to go right to it, updated here up to the minute. We're at 4.58. So a 23 basis point drop. Okay, so we've basically already had a 0.25% drop just this morning. So we'll see what happens here with the 10-year. But as people are rushing to bonds, we are seeing the yields drop, and that is going to be potentially a positive for mortgages. We're going to talk about mortgage applications from the last week. What happened? Did these lower rates actually spur more people to go and apply for a mortgage this week? We'll talk about that in just a second. But it looks like that prediction that we talked about yesterday from David Freeberg, a venture capitalist, where he made a bet with one of his friends. He said, by the end of the week, he believes that the 10-year yield rather is going to drop below 3.3. Well, we're already at 3.4. And if it goes below 3.3, we've seen it get close to that 3.2 level a couple of times. And when it does that, we hit 599 for that one day on the 30-year fixed. Okay. Remains to be seen. We don't know exactly what's going to happen there, but certainly as the 10-year drops everybody in housing watches that closely. It's a boom for housing, as it's typically a boom for the stock. I'm sorry, for the 30-year fixed. Okay. Again, stock markets are getting crushed. Let's just take another look here. Where are we at? Still okay. It's come back a little bit, down 450 points. So rebounding a little bit. We'll see. All of the regional bank stocks are back down. The majority of them. Regional bank stocks, European government bonds are rallying just like ours. Here's the other bit of news as it relates to the U.S. economy that I wanted to cover. Our retail sales dropped. Okay, so if we're looking for reasons why the Fed is going to not increase the interest rate next week, right? There was belief that it was going to be 50 basis points. Yesterday, 90% of the market is pricing in a 25 basis point hike. A lot of people want to see a pause on the federal interest rate. If we're looking for more reasons why they should pause, aside from the banking crisis, here would be another reason. According to Wall Street Journal, just this morning, U.S. consumer spending declined in February after a hot start to the year. So retail sales fell 0.4% last month. This just came out today. Retail sales declined in February. Consumers pulled back after that strong start to the year amid these high interest rates and inflation. Spending at stores, online, and in restaurants fell by seasonally adjusted 0.4%. January sales were revised up to 3.2% gain. Retail sale figures aren't adjusted for inflation. So consumers spent less at restaurants, auto dealerships, department stores, and more essentials like groceries and at these health stores. Okay, excluding often volatile auto sales, overall purchases decreased 0.1% in February. Good. Okay, we had a little bit of a bumpy CPI report yesterday where we saw overall inflation come down, but we saw core inflation tick up 0.1% more than expected. Okay, so this is a little bit of good news here for us. Household purchases represent about 70% of total economic output in the U.S. Retail sales have been volatile of late, falling on a seasonally adjusted basis. During the holiday season before a strong gain in January, over the past year, retail sales have advanced 5.4%, slightly slower than 6% consumer inflation, which we saw yesterday. The economy appeared to start the year on a strong note. The last 2 months, we've seen employers add 800,000 jobs. Okay, so there you go. A little bit of good news. And okay, the banks are having some trouble. We're not saying any of these banks are going to fail. But as long as these reports continue to come out, the banks are having trouble, like Credit Suisse today. And we see potentially good signs that while it's a slow moving, move towards disinflation, we are having some of that. Retail sales, the CPI report yesterday, there could be a case to be made for the Fed to do nothing next week. I don't believe that's what they'll do. Like I said yesterday, I'm in the camp that they're going to increase 25 basis points, but there's a case to be made that that's what they might do, because the more they increase that rate, the more pressure they're going to put on this fragile banking system. They're kind of caught in a pickle right now. Okay. They want to not collapse banking for sure. They made that clear Sunday night, but they really want to get after housing. They've been saying that for 6+ months. They want to put housing in a reset mode. Well, it's going to be hard to do that if rates, the 30-year fixed, continue to drop. So they're in a weird pickle right now. The 30-year fix is certainly looking like it's going to drop today, with the 10-year on its sharp decline. What's not on a decline is mortgage applications. They increased. This just released this morning from Mortgage Banker Association. Mortgage applications increased 6.5% from 1 week earlier. Weekly mortgage application survey for the week ending March 10th, 2023. So this market composite index, a measure of mortgage loan application volume, increased 6.5% on a seasonally adjusted basis from the 1 week prior. On an unadjusted basis, the index increased 7% compared with the previous week. The refinance index increased 5% and was 74% lower than the same week 1 year ago. Of course, The seasonally adjusted purchase index rate increased 7% from 1 week earlier. The unadjusted purchase index rate increased 8% compared with the previous week and was 38% lower than a year ago. So better than the 43% that we've been seeing the last couple weeks when we compare it to a year ago. Yes, we have almost 40% less demand than we had a year ago. We also, in many markets, have far less inventory. I know some would buck that trend. Let me know in the comments where it is up to this week in your market. The average contract interest rate for a 30-year fixed rate mortgage with conforming loan balances of $726,000 or less decreased to 6.71. That was earlier in the week. I believe with the 10-year that we're talking about right now, again, we're going to see this at lower than 6.5%. This is the strangest market I've seen in my 20 plus years. This is Matthew from New Jersey. Matthew, last week, I was in Greenwich, Connecticut doing a talk. And then the week before that, I was in Boston. In both of those markets, there were people in the room that had been in the business 40 years, 45 years, 50 years. And when I asked them, have you ever seen anything like you saw not even talk about right now, this is just crazy volatile, all this stuff that's going on. But when I asked them, have you seen anything like you saw the last 2 years, right? Because what people keep making the mistake of, like, was one of these rates are going to come back and get back to the last 2 years. All of them said they've never seen a market like the 2 years before this year. Talking about 21 and 22. This year, coming off of a market like nobody has ever seen in 40, 50 years, is of course going to be wacky as it tries to get back to normal. It's been extremely volatile. It's expected to be volatile. Maybe not this expected, because I'm with you, Matthew. I've never seen anything like it. Let us know in the comments if you've experienced anything like this, where every single day you could be at 7% interest rate. You could be at 6.25 on the 30-year fix. The 10 years bouncing up and down. Usually doesn't move this sharply in any given day, right? You see low inventory, but then you see other markets where inventory is increasing. It's all over the place right now. I've got a chart for you guys down below for the updated up to the minute mortgage application. So if you want to grab that, you can do it in our daily download link down below. Our daily download link gives you all the sources and all of the charts each and every single day. Jody says we're still seeing multiple offers in homes in our market place from 250 to 280. I think that's going to happen for a long time in every marketplace. You're talking about 250 to 280, lower than the national median price point. So we're talking about what I would consider an affordable home. I guess you can make the argument with the interest rates where they are that maybe that might not even be affordable for, certain communities. But that price point, anything below the national median price, is going to be multiple offers for a long time if it's well kept and, it's not a tear down or something like that. Okay, seasonally adjusted. Sorry about that. Let's see if we can get it back. I guess we cannot. Let's see what's going on here. All right. Well, it's down below. I know what happened. This iPad update is really, really awesome. I already went and changed it. So if you guys don't know, iPad update, if you ever want to mirror your screen, okay, if you want to mirror your screen, you got to go in there and manually do it, which I did this morning. And now it is not working again. And here it is. I had to go do it once again. We've got to call, who is it? Tim Cook. We need that update to be reversed. Mortgage purchase application index here. Here you go. We're back down to, while we saw an increase last week, we're back to a low point going back to 2014. Okay. So while I understand, like Jody just said, there's multiple offers. This is a really bifurcated market. You're going to see that in a certain price segment in a certain town. The reality is, in comparison to the last 8 years, outside of that sharp COVID drop right here, outside of that, in the last 8 years, we haven't seen this low of demand. It's the low inventory that's driving this feeling of high demand. It's not actually high demand. It's low inventory that's driving the feeling of high demand. The only other times we had this low of demand was, 14, 15, and then the years right after the GFC call it 2009, 10, 11, 12, that time frame. Okay. Just the numbers, just the reality, just something for us to recognize of what is going on. But the good news is 2 weeks in a row now, we have mortgage applications up. So good news there. Bad news as it relates to mortgages is the monthly mortgage payments are at an all-time high. This is on nowbam.com down below in your daily download link with all of our sources and downloads. According to a Redfin report, typical home buyers' monthly mortgage payment hit a new all-time high of $2,563. On the other end of the spectrum, Redfin reports rents have dropped to the lowest level in a year. This is what we were talking about yesterday with the CPI. Once that figure catches up to the lagging data that goes into the CPI, that should drop that overall inflation number, hopefully by May, because May's the big year-over-year report that we're going to have. Hopefully by May, that'll drop it significantly and really entice the Fed to loosen up. The dream of owning a home is becoming more elusive than ever before, according to this new Redfin report, with mortgages sitting around 7%. Hey, today we're going to get lower than 6.5%. The typical home buyer is now shelling out $2,500 each month. It's a $29,000 increase from a year ago. If I'm an agent and I know a apartment community that their average, spend is $2,500 or over, some of these luxury communities, that might be one to target right now, right? That might be one you should you be sending your mailers to an apartment community that has $1,200 average rent when the average mortgage is $2,500, or should you be sending it to the people that can afford it? I'm just throwing that out there. Listen, I want affordable housing. If you watch the hot sheet, hit the thumbs up. I've been just over the top about how we need to get a fix for affordable housing. But as we sit here next 30, 60, 90 days, what's your marketing plan look like? Might be a good idea to go after people that are already paying $2,500. 2021, the typical monthly mortgage payment was just $1,400. Okay, so it's another $1,100 on top of what it was today. Look at Matthew back from Jersey. I have a feeling the government will step in and further and offer incentives to home buyers while pushing rates higher to balance the market. Well, they've been making incentives to home buyers. The problem is the incentives are for the buyers that are competing in that range that Jody had, right? Where that Jody's comment where it's 250 to 280, this is where a lot of the incentives work out. So you got people competing with them, cash, investors, all these things. So these incentives also oftentimes create more buyers in the price ranges that are already ultra competitive. Multiple offers on San Francisco homes on single family homes in the St. Paul, Minneapolis area, but a nosedive in prices in the condo market. Interesting. Is it the fees in the condo market attached to the mortgages that are driving those up? Love to know what your thoughts are on that. To put into perspective, let's look at some numbers here. The following numbers are a home buyer with a monthly budget of $2,500. With today's average mortgage rate around 7%, buyers can afford a $375,000 home. A month ago, when rates dropped to 6%, the same budget could afford a $400,000 home. A year ago, with rates around 3.85, those days are long gone. Same buyers could afford a $480,000 home. Okay. Pending sales down 16% year over year. Okay. New listings homes, we've been talking about that a lot, way down. And then here you go. Here's that mortgage payment. Here's that rent payment. We've got this one down below for you. The median asking rent was $1,937 in February. That's down from $2,053. The expectation is that rents will be lower later in the year, that this number will come down even more later in the year. The Fed's counting on that. Certainly hopeful to see that. And right now that is the trend. So good news there as it relates to rents, because hopefully that'll ease up the Fed. The mortgage rates obviously are not good news on these payments. Yes, inflation has driven up monthly HOA fees. So yeah, I'm seeing that. And even the CPI report that we talked about yesterday on the hot sheet, these services, trash services, and landscaping services and maintenance services, they've all gone up, which means people's HOAs are going to go up. Okay. If you're in a community where taxes have also gone up, property taxes and HOAs, and then now the mortgage payments, yeah, that's all of a sudden making mortgages less desirable. Along with the mortgage payments being up, we know that delinquencies are down. If you've been following the hot sheet, delinquencies are at a all-time low or near all-time low level for mortgage delinquencies. Not the same for consumer debt. Consumer debt is at a record 16.9 trillion as delinquencies are also rising. Consumer debt across all categories totaled almost 17 trillion, up about 1.3 trillion from a year ago. This is like what we're talking about with these HOAs. Okay, if I'm living in a condo, now I'm going to pay more for my HOA, but all my living expenses are up. Where do I go get that money? I go put it on my credit card. Mortgages, auto loans, and credit card delinquencies all increase. Now, mortgages, this is very misleading, CNBC, because we've been covering it here on the hot sheet. Maybe you should have me come on, because mortgages have not. 17% have increased in 17% of different communities have increased in the last 3 months. That being said, we're at a near all-time low. So super misleading. They do say still to low levels. Okay, so there you go. Consumer debt hit a fresh record at the end of 2022. All delinquencies rose for several type of loans. That's the big one, because people are gonna stop paying their credit card before they stop paying for their mortgage or their utilities, right? And in fact, credit card debt is the #1 dating deal breaker for millennials. It's easy to understand why, says a financial therapist. Jeez, I don't know if I need to have a conversation with that person. Which of these financial topics were deal breakers, potential partners while dating? Personal loans, 31.5%. Credit card debt, almost 30%. Lack of financial literacy. When I listened last week to that talk in Washington, D.C. with Jerome Powell, imagine if that was this week, by the way. Imagine if Jerome Powell was in front of the House and the Senate this week. That would have been bonkers. But man, I thought I had a couple hours there of lack of financial literacy listening to those people. Irresponsible spending, student loans, too low of a salary. You don't make enough. You're out. High mortgage rates, 20%. Still on your parents' insurance. That sounds like a benefit to me. I think you can do that till you're 26 years old. No investment, still living with parents. No savings account, no retirement account. So millennials are getting antsy here. Okay, it looks like millennials are getting antsy as they age up here in life. Have you argued with your romantic partner about any of the following? Spending habits, 37%. Yes. Investments, 35%. Salary. Imagine that. I mean, I guess if you're your spouse's boss, maybe you could argue about salary, but what's the argument? Like, you need to go in there and tell your boss, make more money, get a second job. Life insurance, 30%. Buying property together, 30%. We know, 8 out of 10, 9 out of 10 millennials have been reduced to tiers when it comes to buying a property together. So I actually think this is low, that 30% have argued about it. Okay. The bad news is we know where car payments are. We know where, unfortunately, we've got bad news here today. I'm sorry, guys. Don't kill the messenger. That credit card debt is increasing, as well as the auto loan debt. And that's going to be the first to go. And so hopefully they figure out this bank situation, because if people don't have a secure place for their money, and they tend to don't have a secure place for their job, if that were to become the case, this could leak into other areas, and we don't want to see that happen. Okay, T360 just released their top 5 rankings for real estate enterprises, brokerages, franchise brands, and franchisees. Let's see what they are. Stefan said the majority of companies listed saw year-over-year declines in production and volume, some almost exactly matching the nationwide market decline. But the notable expectations, including EXP and the top franchisee Remax Gold, representing Gold Nation, showcased massive increases despite this market downturn. We applaud everyone who's made the T3 top 5 rankings in 2023 and look forward to tracking and analyzing their progress. Okay, top 5 real estate enterprises. Anywhere Real Estate, 636 billion. Keller Williams, 440 billion. Remax, almost 300 billion. Home Services of America, almost 250 billion, and Compass at 228 billion. The biggest drop year over year would have been Home Services of America at 15.3%, of a drop. The top 5 real estate brokerages: Compass coming in at number 1, 228 billion, Anywhere 222, Home Services of America 165, EXP at 160, and Douglas Elliman at 42 billion. Man, number 5. It seems like there's a opportunity there to jump into the 5 spot. A big drop off from 4 to 5 as it relates to the brokerages. Top 5 real estate franchise brands: Keller Williams 440 million, Coldwell Banker almost 300 million, Remax almost 300 million, Sotheby's International Realty 146 billion, and then Berkshire Hathaway Home Services 146. The reason why you have these enterprises, because home services has their brokerage, they have their franchise. That's why you see them then again on both lists, brokerages and franchise brands. They're kind of broken up, right? If you're at Coldwell, there's some Coldwell franchises, then there's some company owned Coldwells. So that's why you're seeing these same names on the same list. Top 5 real estate. So those are franchise brands. And then here's the top 5 real estate franchisees: Remax, Majestic Realty, Keller Williams Realty, and Berkshire Hathaway Home Services. So that was just released. Figured I'd share that with you guys. Let's take a quick look at where we're at right now on the 10-year as we sign off. Continues to drop. Good news for the 30-year today. We're at 3.419. I mean, we could see a 30-year 6.25 to 6.5 range. I don't know. Let's see where the 10-year continues to go. Yesterday, when we ended the day, we did in fact jump back up to that 6.75 range. We saw that, right? These regional bank stocks were up. The stock market went up yesterday. The 10-year went up, and we knew the 30-year, unfortunately, was going to probably go back up, and it did. Well, now we have sharp declines in the market. Dow's down 550 points. We have a really sharp decline in the 10-year that we just looked at, and I would expect that the 30-year fixed will go down. All right. If you're looking to provide any content for your marketplace this year, make sure you grab the free ebook below, which is your video equipment for any budget: low budget, high budget, medium budget. We've got it all down below for you in the free ebook link below. Hope you enjoyed today's show. Consider sharing it with somebody who wants a 24-hour look back on what we are doing with housing. Don't forget, we have that daily download link down below where you get all of our sources and all of our slides in one place every single day. You sign up once, you get it every single day. Until tomorrow, have a great day, and toodaloo.